This is America's Roundtable. Visit us at americasrt.com. Follow us on Twitter at americasrt. You can find us on YouTube and Facebook. Like and share. Thank you for joining us on America's Roundtable, a weekly radio program from Washington, D.C., with leaders from business, media, think tanks, and the political arena. I am your co-host, Joel Anand Sami, joined by Natasha Sarduch, co-founder of International Leaders Summit and former contributor to the Economist Intelligence Unit. Our discussions and in-depth analysis on America's Roundtable cover economics, the rule of law, trade, and security. We are pleased to be joined by Dr. Steve Hanke, a professor of applied economics and co-director at the Institute of Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University in Baltimore. Dr. Hanke is a senior advisor at the Renmin, University of China's International Monetary Research Institute in Beijing, a special counselor to the Center for Financial Stability in New York, a member of the National Bank of Kuwait's International Advisory Board, chaired by Sir John Major, a member of the Financial Advisory Council of the United Arab Emirates, and a contributing editor at Globe Asia magazine. In the past, Professor Hanke taught economics at the Colorado School of Mines and the University of California, Berkeley. He served as a member of the Governor's Council of Economic Advisors in Maryland from 1976 through 1977, as a senior economist on President Reagan's Council of Economic Advisors in 1981 through 82, and as a senior advisor to the Joint Economic Committee of the U.S. Congress in 84 through 88. He played an important role in establishing new currency regimes in Argentina, Estonia, Bulgaria, Bosnia-Herzegovina, Ecuador, Lithuania, and Montenegro. Professor Hanke has also advised the governments of many other countries, including Albania, Kazakhstan, and Yugoslavia. In 1998, he was named one of the 25 most influential people in the world by World Trade magazine. Professor Hanke is a recipient of 3 honorary degrees from the countries of Ecuador, Georgia, and Turkey. Professor Hanke is a well-known currency and commodity trader. Currently, he serves as chairman of the Richmond Group Fund Company Limited, a global macro hedge fund located in Richmond, Virginia. He's also chairman emeritus of the Friedberg Mercantile Group in Toronto. During the 1990s, he served as president of Toronto Trust Argentina in Buenos Aires, the world's most performing emerging market mutual fund in 1995. Professor Hanke and his wife, Liliane, reside in Baltimore and Paris. It is a great delight to have you join us, Dr. Hanke.
Dr. Hanke, it's always a great pleasure to talk to you. It would be good to hear your thoughts. How did we get in the economic crisis that has spread around the world?
The main cause of the crisis are the central banks. And of course, this means in the United States, our Federal Reserve System is the central bank. What you had, really starting with Greenspan, let me just start in that era. He came in late 1987, right after the stock market crash. There was a huge stock market crash in 1987. And of course, as a result of that, the Fed panicked and stepped on the money supply accelerator as fast as they could. And they pumped up a little bubble in the economy that followed. And then they got very worried about inflation picking up. And boom, then we had the economy going into recession in late 1990 and early 1991. That was the reason, by the way, that Bill Clinton won the first election that he won. George Herbert Walker Bush lost that election. The economy was in a little recession then, but it was caused, you see, by the Fed doing what they always do. There was an event, the stock market crash. They panicked. They pumped a lot of money in the economy, blew up a little bubble in the economy, and then inflation started rearing its ugly head, and they got scared, and then they put the brakes on, and they drove the economy into a recession. And then things went along in the Greenspan years. They were more or less calm until late 1997, 98. And remember then we had the Asian financial crisis, and we also had the Russian ruble crisis, and LTM, one of the big hedge fund went bust in the United States, and the Brazilian real blew up in early 1999. Now, all of that, of course, caused the Fed to panic again, and they pumped the money supply up. They created another bubble, and then that bubble was followed. You remember when the tech stock boom crashed, and we had a stock market crash, and after the Fed had blown the bubble up, we had the stock market crash, and we went into another recession. And the recession was followed by, the Fed pumping up really the mother of all bubbles, and this gets into the kind of overlap with the end of Greenspan's era and the start of our current chairman, Bernanke, at the Federal Reserve. I'm going through this because you see the cyclical panic, boom on the bubble, and then panic again, and they slamming on the brakes, and you have a recession. So it's a cyclical kind of action that the Fed gives us. But this last one is we're talking about the current crisis now. That's where we're at, and we start that in November of 2002. When Bernanke, who wasn't chairman of the Fed yet, he was a governor of the Fed, he gave a very important detailed speech in November of 2002, and Bernanke made the argument at the time that our biggest danger was the threat of deflation. That would mean instead of general prices going up, they would be going down and be in negative territory. And that he was arguing this was a big threat and a big danger. Well, Greenspan was still chairman. Greenspan bought onto this argument, and then the Fed started pumping up the money supply. This was in 2003, and remember, by mid-2003, they pushed the federal funds interest rate, that's the one the Federal Reserve controls, down to what then was a record low. It was 1%. And the money supply was roaring away. This is starting in 2003. And then you say, well, what, so what? Because the consumer prices weren't going up. The Federal Reserve has what they call an inflation target, and they try to keep prices around going up at about 2% per year. And this thing was just behaving beautifully, very smooth. Every year it would go up, more or less 2%. But underneath that, there were lots of problems. And if you look at the consumer price index from 2003 through 2008, because the third quarter of 2008, that's when the Lehman Brothers blew up and went bankrupt, and that was in the United States, at least, that was kind of the official start of the panic and the crisis, was the third quarter of 2008. So if you look at 2003 through the third quarter of 2008, the consumer prices only went up a total of 12.5% in that period. But if you look at home prices, that was, everybody keeps talking about the housing bubble. Well, there was a bubble. The housing prices went up 45% in the 2003 to the first quarter of 2006 period. That's when they peaked out. The stock market, though, was even in a bigger bubble. The stock market went up 66% from the first quarter of 2003 until it peaked in the first quarter of 2008. But the thing that was really on terror was were commodity prices. And commodity prices went up in that period of time 92% from first quarter of 2003 until the second quarter of 2008. So we had a huge divergence in prices, and with the consumer prices, their target behaving very well, gradually going up about 2% per year.
Was it, I just wanted to ask you, was this having inflation within the expected range that nobody reacted in time? Was that the reason that they didn't see the crisis coming?
Yeah, they have the wrong target. I mean, if you're driving a car, Natasha, and you have the wrong speedometer on, or a miscalculation and the wrong metrics being displayed in your speedometer in your car, you're going to be in trouble. And the point is that on his dashboard, Bernanke is only looking at changes in the consumer price index. He isn't looking at all these other changes. So as far as he is concerned, he's driving in the speed limit. Everything is fine. Nothing is malfunctioning on the dashboard. And of course, the key thing he doesn't have on the dashboard, the key to the commodity price explosion was once the money supply started really going up, and after 2003 started, the dollar collapsed against the euro in that period of time, 2003 to mid-2008, the summer of 2008, the dollar went down by 44% against the euro. And that is why commodity prices exploded, because remember, all commodities are traded in international markets, and they're invoiced and priced in U.S. dollars. So even forgetting the supply and demand fundamentals in these markets for corn and rice and oil is a big thing. The dollar euro exchange rate is a key thing, because if the dollar gets weak, that means everything gets repriced and the price in dollars goes up just to keep the thing in an even keel. Or if the dollar is getting very strong, like it did after the Lehman collapse in September of 2008, what happened? The dollar went up just during those last few months of the year. It went up about 25% against the euro, and oil, which had been at a world record high in July of 2008, it was $147 a barrel. It collapsed.
Right.
Gold collapsed. Rice, with a world record high in the middle of 2008, it collapsed. So none of these central bankers saw this thing coming. I can remember I was testifying before Congress in July of 2008, and the big issue, and the reason for the testimony, was food prices. We had just hit all-time high in world rice prices, and all the food prices, or agricultural commodities were going through the roof then. And of course, the dollar had completely collapsed. Remember, that was the low point of the dollar versus the euro. So, of course, food prices were going up. And I testified, I'd done some analysis, and it turns out about 50% of the price increase in commodities from 2003 until July of 2008, about 50 to 60% of those, like oil, for example. People were complaining about OPEC and the Middle Eastern suppliers and all these things. They were small potatoes. The big cause of the whole thing was the Federal Reserve Bank, which let the dollar get very unstable and very weak. Now, the politicians, of course, wanted that, because this was the Bush administration at the time, or the Republicans, and of course the Democrats are just as bad. They think that a weak dollar is a very good thing, because that it promotes U.S. exports, you see. Well, it turns out an unstable dollar is a very bad thing.
Right, exactly.
But why don't they factor in, I mean, obviously when you mentioned they have a dashboard with the wrong signal on it, the speedometer is not working, why don't they fix speedometer? And what should they do in order to have all these gauges?
They're simply not going to fix it as long as Chairman Bernanke is in the driver's seat, because he is one of the intellectual engines behind the whole idea of inflation targeting. In other words, the central bank should have a target for price, an aggregate price like the consumer price index, and as long as they're hitting that target, that everything is fine.
Right, so, but oil and housing, I mean, oil and houses should be included also in prices, because that's also.
You see, this gets back to fundamental kind of, particularly the so-called Austrian School of Economics, this would be people like Friedrich von Hayek or Ludwig von Mises, Gottfried Haberler, Fritz Machlup. These are the names of the most famous Austrian economist, Joseph Schumpeter. These are all names from this kind of Austrian school, and their point is no, the aggregate number, the consumer price index, it just hides everything that's really going on in the economy, and you have to look at all these other asset prices and commodity prices. So there have been times when that's been the case. When President Reagan was president, he made a number of appointments of so-called supply-side-oriented economists. One was Wayne Angell. He was on the governing board of the Fed, and the other was the vice chairman at that time, was Manley Johnson. And they, on their dashboard, they had about 25 to 30 prices that they were looking at. So they had a whole bunch of commodity prices, like obviously oil. Gold, they were looking at the gold was a key thing that they were looking at. The foreign exchange, the price of the dollar, they were looking at. So they were focused on prices of a whole range of things. And if they would have had that kind of dashboard set up, this last disaster that we've been in would have never occurred, because all these prices, as I've recounted to you when we started, it just went out of whack. And by the summer of 2008, everyone should have known that something terrible was going to happen, because you had soaring commodity prices, soaring stock market, soaring housing prices. Actually, the housing prices went up much less than the stock market, and way to a way lesser degree than commodity prices did. So for those of us who have a different kind of dashboard set up, and one that would either be a supply side or Austrian type of approach, we saw this train wreck coming way before it did. And the problem with these modern models that most economists use, you see, they aggregate the models. So you say, well, what are the elements in the models? Well, you've got private businesses. You've got government, that's part of the model, and you've got what's called households in the model, and that's about it. Now, one thing, notice I didn't mention the word bank, because there are no modern models that are used by economists that have banks in their model. So, of course, if things were out of control and credit was being, blown up by banks, how can you see it if it isn't in your model? It's a dashboard problem again.
Right.